Hello and welcome to Quarterly Perspectives, Q2 2023. This is Ryan Mahoney at Cypress Asset Management, and I will be your host once again for today's presentation. Herein we will discuss quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We will then go on to discuss recent interest rate movements and inflation expectations. Lastly, we will examine how different asset classes contributed to an overall portfolio return. We hope that you enjoy today's presentation. Now let's get started. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from this illustration, U.S. developed, international, and emerging market stocks were up during the second quarter, continuing the positive trend from the previous quarter. Returns for bonds were mixed, with U.S. bonds posting negative performance for the quarter and the trailing 12-month period, while global bonds were slightly up over those same time periods. Next, let me draw your attention to the upper right-hand portion of the graphic. The U.S. dollar was up 0.4% for the quarter, but is still down 1.7% over the last 12 months. Now let's take a little deeper look at what was driving the returns of stocks and bonds. We will start by taking a look at how global equities performed for the quarter, and we will then isolate the performance between the U.S. and developed international stocks. Two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell indices, and international market returns are measured with the MSCI World ex-U.S. Index Series, which represents the global developed market performance, excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market was up 8.4% in the second quarter. That was a monster quarter, compared to up 2.7% for developed international markets on the chart on the right. Growth stocks, on average, outperformed value stocks in the U.S. and vice versa for international markets. Large growth stocks had the best return in the U.S. Large value stocks came out on top internationally, while small value stocks lagged in both regional markets, continuing the trend from last quarter. But no matter these recent trends, it's important to remember that we should not make longer-term projections based on short-term performance. Now let's take a look, or rather a longer view, to see how different investment styles have performed for standard periods ending June 30th, 2023. Looking at annualized returns now in the U.S., we can see that markets have shown resilience, especially over the trailing one-year period, when faced with significant headwinds, such as ongoing fears of global recession, continued rising interest rates to help bring down inflation, and growing concern for the commercial real estate sector. Despite these potential issues, U.S. markets returned 19% during the last 12 months and exceeded 10% per year. During longer time horizons, large growth stocks have had the best performance for the trailing one-year period, gaining 27.1%, which beat the U.S. market by 8.1%. We can also see that small and value stocks have generally been out of favor during these time periods, with a 3-year period being a notable exception. Consequently, we expect that portfolios that have a small value tilt, such as those as we typically design for our clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer time horizons. Keep in mind, however, that very long-term evidence demonstrates that on average, small stocks outperform large and value outperforms growth. But size and value factors can still go through extended periods of underperformance like those shown above. Turning now to international markets. we see that large cap growth stocks have led the pack over the 1 year period. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering some of the highest returns over the 10-year period at 6% and 6.4% respectively. Relating to the prior slides, we see that international markets have underperformed the U.S. market at all time horizons, with the 1 year performance trailing by 2.6%, the 3, 5, and 10-year performances trailing by 5%, 7.2%, and 6.9% respectively. Given these higher U.S. returns overall horizons rather, we expect portfolios concentrated in U.S. stocks to have outperformed a globally diversified portfolio. However, as we will see in the next slide, these relative performance numbers are not reason enough to abandon international stocks. Okay, thus far we have discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measuring the price to earnings ratio. This is a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is to own overall. Thought of in another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total U.S. stock market costs roughly $20. Internationally, as we can see in the chart on the top right, earnings are cheaper at $13 per dollar of earnings on average. The values represented here use historical fund and ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for U.S. measures and in the fourth quarter of 2006 for international stocks. Noting the strong U.S. market performance during the last 12 months, we see the broad U.S. market is now trading above its recent historical average. We can also see that international markets and small value stocks in developed markets appear cheap relative to their recent historical averages. Now, all else being equal, we would like to pay obviously less for a dollar of earnings. These valuation ratios aid in setting expectations about the future. Low valuations today imply higher future returns and vice versa. The recent strength of broader U.S. market performance means that it's reasonable to expect, though not guaranteed, but reasonable to expect lower returns than in the past when valuations were below their long-term historical averages. Now, the opposite is true for international markets and small value stocks. Globally, it's reasonable to expect higher returns than in the past when valuations were above their long-term historical averages. But I will emphasize that this is a long-term relationship and that short-term outcomes will likely be dominated, as always, by unexpected forces such as the dramatic interest rate increases, stubborn inflation readings, ongoing war, and bank failures that we've seen in the past 12 months. Here we have the same analysis, but isolating U.S. equities so that we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings as the PE ratio has climbed to 31 to close the quarter, which is above its average since 2004. Small value, on the other hand, even with the rebound of value stocks relative to growth stocks during the past 3 years, still has a PE ratio of 7.7 and remains under its average since 2004. Although investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted towards small, relatively inexpensive companies. Next, we will take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing inflation. The charts on the screen here show the average performance of the different bond maturities in the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left-hand side, we see that bonds of all maturity ranges had negative performance, but markets favored short to intermediate maturities relative to longer maturities. The chart on the right shows the performance of different intermediate maturity credit quality bonds, and we see again that all bonds in the credit qualities listed were down for the quarter, with investors favoring corporate and municipal securities relative to other government and inflation-protected debt. Okay, now let's take a look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show the current yields for Treasury bond investments at different maturities. The light blue line represents current rates, the dark blue line represents rates from the end of the prior year, and the gold line represents rates from 1 year ago. Rates increased for all maturities during the quarter, particularly at the shorter end of the curve, with ultra short-term rates exceeding 5%. Looking forward, expected returns for fixed income remain elevated to this time last year due to the Fed's rate hike program. For long-term fixed income investors, this is likely to be a net positive, as new money in maturing bonds are reinvested into higher-yielding bonds. The yield curve remains inverted, as it was at the end of last quarter. And when this happens, particularly between the 2 and the 10-year points on the curve, it's widely regarded as one of the precursors but no guarantee to an impending recession. Finally, we plot the market's forecast of inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations, the dark blue line represents inflation expectations from the end of last year, and the gold line represents inflation expectations from 1 year ago. Consistent with what we've been hearing and reading in the media, the Fed's aggressive rate hike campaign has led markets to lower current estimates for future inflation compared to this time last year. Inflation expectations lowered slightly for the most part across the curve this quarter. As these expectations continue to change, it's important to remember that these levels of inflation are baked into today's prices. Markets are pricing an average inflation rate of approximately 2.2% per year for the next 5 years, and the market collectively expects inflation to slightly outpace the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices today, but they're also baked into equity prices, making a bet on higher inflation would therefore mean that we expect inflation to exceed the current forecast. Okay, next let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter and how that index mix behaved during recent history. On this slide, we're looking at the absolute impact of different asset classes and the returns on the quarterly return of a sample 60% stock and 40% bond index mix. With stock and bond markets moving in opposite directions this quarter, we can see that most stock asset classes contributed to the overall increase of the index mix. U.S. large cap stocks were, of course, the largest contributor for the quarter, while international small value stocks were flat in terms of contribution to overall return. Diversifying stocks across geographies and investment styles contributed to positive returns, while an allocation to bonds detracted from them this quarter. This resulted in the 60-40 index mix achieving a return of 3% versus the U.S. total market return of 8.4%. The portfolio captured a portion of the stock market's appreciation while controlling for risk. Here we see a collection of major asset class calendar year returns displayed on a quilt-like chart. Looking at year-to-date returns in the rightmost column, we see that all asset classes posted positive performance, with the S&P 500 a popular headline index primarily tracking U.S. large growth company performance, gaining the most value at 16.9%. A diversified index mix such as the 60/40 stock to bond index mix shown in the white tile tends to stay away from the extremes, both positive and negative, on a yearly basis and over time, while also dampening the volatility of returns. This is an example of the potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not take away our ability to prosper for the many quarters to come. Okay, and with that, we have reached the conclusion of today's presentation. Thank you once again for joining us, and we will catch you next quarter.